Hello, friends. Today I am giving you an update on Visa, ticker symbol V. We'll be looking at some of the performance of the stock, the latest earnings valuation, and we'll give you an updated target price, at least for me. So welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. Visa has been doing pretty good. I own Visa, just so that you guys know. In the last 5 days, it has been up for 0.77%. In the last month, it's up 5.3%. In the last year, it's up 24%. Target price from the analyst is 287 cents. No, $287.39, which will be an upside of about 3.1%. They reported earnings back on January 25th, and they are trading right now at 32 times earnings with a forward PE of 27 times. The current PE it's at $8.68. They went already ex dividend. They pay a dividend of $2.08, which will be somewhere it's 0.75%. Visa, whenever reported on January 21st, they beat on EPS and GAAP EPS and revenue. They beat revenue by $76 million and by normalized EPS by 7 cents and GAAP EPS by 8%. Next time that they report will be somewhere around April 26. They are expected, their earnings is they're expected to grow. The estimated it's about extra 2 cents, and the revenue it's supposed to remain close to flat. EPS revisions in the last 90 days has 23 upside revisions and 8 downward revisions. As you can see, the quarterly EPS continued to grow very steadily. This is something that I love about Visa, and the reason why I own it is because I like their consistency. Like I mentioned in the video before in Google, that I am starting to move more into not just being a value investor, but also moving into more being a quality investor. And that's part of the reason why I really like to analyze some of the companies and look at their graph. By the way, if you like the content so far and the things that I am doing in this channel, please subscribe, leave a like, a comment, maybe a question, or if you want to let me know what your bull case or your bear case for Visa is, let me know. If you are going to tell me that PayPal is better than Visa, please write it down there and let me know why. So I would love to hear your comments. When it comes to revenue per share, Visa has been growing in the last 5 years, but been growing at 9.8%, and in the last 10 years, 12.3%, which is really good numbers. When it comes to gross margin, this is one of the new statistics that I'm following, and this is something that I've been hearing from Terry Smith. He's a British investor. He's looking for above 60%. Well, Visa has 82% of gross margin, and that which means is that they are very resilient. They can withstand whenever costs go up or whenever they have some kind of margin contractions. So that's really good. When it comes to earnings have been growing in the last 5 years. Earnings per share of above 10%, and in the last 10 years, almost 15%. I may have mistakenly said the first number, 5 years, 10%, 10 years, a little bit lower than 15%. When it comes to the average profit margins, this is really good. I look for somewhere above 25%, and Visa has profit margins average of 51%. That means that for every dollar that they sell, they get 50 cents in profits. That is great. When we go to free cash flow per share has been growing also very nicely and consistently. Even though, so one of the things that I like to do is I like to look at when it comes to revenue, all the graphs. I want them to look that they're growing steadily, like right now in revenue, like in earnings. Free cash flow, I can see a little bit of ups and downs. So that will be something for me to research a little bit, like, okay, why does this look like this? But in the last 5 years, they have been growing their free cash flow by 11.5%, and in the last 10 years by 10%. Free cash flow margins are awesome. They're way above my 25% minimal. I mean, not minimal, but what I like to see in a company. At 60%, that is great. That means that for every $100 that they sell or they make in revenue, $60 go to be part of their free cash flow. That is great. And the last 5-year free cash flow yield average is 3.2%, which this is also pretty good. This is actually a great number. It's not amazing, but it's pretty good. Book value per share has been flat. They're not growing their book value too fast, too much. The last 10 years, it's 2.8%. And in the last 5 years, 4.4%. I don't worry about that too much. The 5-year average of return on equity is 35%. Pretty nice. I normally look for above 15, but Terry Smith, it's convincing me to look for 25% and above. Return on invested capital, same thing. It's above my 15%. That's pretty good. And return on asset is 17%. By the way, let me know what you think about this whole return on invested capital being above or close to 25%. And these are the companies that we should be looking instead of what I was thinking about, 15%. What is your opinion? Let me know down below in the comments. Dividend, nice graph of growth for the dividend. It's been growing in the last 5 years for you guys, dividend investor that love dividend. It's been growing in the last 5 years at 13%, above 13%. The last 10 years, almost 17% a year. This is CAGR. This is great. And their payout ratio is a 17.5%. They can definitely afford this. When it comes to debt, debt has been going up, but they can pay all of their long-term debt with their average free cash flow in a year and 3 months. So that's pretty good. They're very solid. We normally look for this number to be under 5%. I mean, under 5 times the free cash flow. We don't want them to be in long-term debt more than 5%. 5 times free cash flow. Let me know what kind of debt metrics do you use. I've been hearing about different other metrics like interest cover or EBIT leverage. Just let me know. When it comes to outstanding shares and buybacks, they have been buying back almost 2% of their shares in the last 5 years, and in an average and in the last 10 years, almost at 1.9%. That's great numbers. When it comes to this new page that I have added to all my, I like to now look at the whole summary. So just to explain you again, if you see this yellowish thing, that means that they're wonderful numbers. They're way above average. Whenever you see green, those are above average. When you say blue is good, is average. If you see this kind of orange, they're below average. And we don't have any reds over here, but that will be a risk or a warning thing to pay attention. The number that I want to, I've talked a lot about these numbers, but the number that I want to talk to you a little bit before we go into the valuations is this free cash flow yield. In the last 10 years, the average is 3.63%, and in the last 5 years, 3.22%, which means that if Visa was a bond, you will be receiving about 3.2% in the last 5 years average of the free cash flow. And the way that you can figure out what it is right now is we will be looking right here at the free cash flow. We take 9.57 per share divided by the share price right now is 278.56, which gives me a yield of 3.39%. So that is pretty good. That's what it is right now. Now let's move into our valuation. So I just need to let you know about my disclaimer. I am not a financial advisor. I'm just a YouTuber. Everything that I say here is just for educational purposes or entertainment purposes. I hope you're being entertained. Please don't make any financial decisions based on my decisions and opinions, and I will highly encourage you to make your own research. Also, if you want to get a copy of my valuation, or if you would just like to buy me a coffee, you can go to buymeacoffee.com. The link is in the description, and just leave me a comment and let me know how I'm doing. Thank you very much. When it goes to the historical multiple valuation, we take all the numbers, take the average per share, and the trailing 12 months per share values and dividends, and we multiply them by the medium multiple of 5 years, gives us a average valuation of somewhere between $114 to $168. If we use what I call the revenue-based valuation that I learned or I got from Patient Investor, which is another YouTuber, I encourage you to watch him. You would take the revenue right now, we grow it at 10%, then we take the profit margin. We also buy back all the shares as they have been doing. We divide those two final numbers to give us our future EPS, multiply by our future price to earning whenever we're trying to sell it in 5 years. It gives us a future price of $412.65. We add the dividend that we are going to be receiving. We're assuming we're going to be receiving in the next 5 years. That gives us a total return of $428. And if we divide that by 2, which will be the 15% discount rate on the next 5 years, that will give us close to $214 fair value. When we look at the discounted earning valuation, in which we take the EPS, grow them at 14%, then in the future value, we do the same thing, multiply by a PE of 32, and then divide it by 2 because we want a 15% discount rate. That gives us a fair price of somewhere between $204 to $268, depending upon if you're using the average EPS or the trailing 12 months. When it comes to Visa, I would probably be leaning more on the 12 trailing month. When we look at the payback time valuation, this is from Philtown. You take the free cash flow per share, grow them at a growth rate. We're going to grow them at 10%. And if we assume that we're going to receive all those free cash flow belong to us for the next 8 years, we're looking at a fair value of somewhere between $200 and $257. New valuation that I added. This is the second one that I added. Free cash flow, discounted free cash flow, which I know a lot of you guys love to use. Whenever we put out all the numbers of the free cash flow, we discount them. We sell in the future the company, and we get that. We put it all together. If you want me to make a video explaining more of this, just let me know. But I'm just trying to go a little faster. We're looking at a price somewhere between $223 to $285 as a fair value. When we use the owner's earnings valuation, which is from I got it from Philtown, and he got it from Warren Buffett in one of his letters to the shareholders. We look at a average. We look at a fair value of somewhere between $150 to $188. So we're not going to be paying attention to the owners because I don't think that applies to Visa. And just like I said before, because of the way that it is growing, I'm going to be more focusing on the trailing 12 months. Whenever we put everything together, at least for me, a fair value is somewhere between $158 to $160, which will make it a little bit above the current price. Below the current price. With Visa, I will be okay with. Honestly, I will be okay buying it at a fair value, but I always like a margin of safety. So because it's so good, I will be probably looking at $119, somewhere around there. Please let me know if you agree with me, if I'm missing something, or if you just disagree. Thank you very much, and I hope to see you in the next video.